Hello, and welcome to Markets in Focus. My name is Joe Bell, and today I'm going to walk you through some of the most interesting financial market themes that I'm observing. So, earnings season, we're a little over halfway through the earnings season for the S&P 500, and it's been pretty good. It's surprising to the upside, a pretty historic beat rate. Uh, just halfway through, so we'll unpack that. But we'll also look at a couple of jobs reports data. Government shutdown, that doesn't mean that we're completely in the blind. We had the ADP October report come out, and then also we had the challengers announced layoffs in October that showed a little bit different story. We had a spike in October, so kind of mixed labor market data overall. Now, Q3 earnings surprising to the upside. Take a look at this chart. This is the S&P 500 third quarter earnings growth rate. And you can see on the far right, it is up to 10.7%. That is notable for a few reasons. This chart is basically showing what expectations were for the quarterly growth rate all the way back to the summer. And if you follow the chart through that time, on September 30th, right at the start of this earnings season, expectations were for the S&P 500 earnings growth rate to come in at 7.9%. Why is that significant? Well, today we're at 10.7%. That's an almost 3% increase. And that is on the back of a lot of earnings upside surprises. If you look at the earnings beat rate, that is the percentage of companies whose earnings came in better than analysts expected. It is at 83%. That is very high. That is the highest that we've seen in 5 years, if that ends up being the beat rate through the end of the quarter. It's also significant because if the earnings growth rate stays above 10%, this would be the fourth consecutive quarter of double-digit earnings growth. We continue to also see profit margins stay up and around that 12% area, which is also very favorable. So overall, I think we need to give corporate earnings about an A so far midway through the earnings season. Now, there's no doubt we've had a slowing of the labor market, but perhaps a little bit of modestly positive ADP jobs report for the month of October. Private sector jobs increased for the first time since July. We added a net 42,000 jobs in the month of October, according to ADP, the payroll company's payroll data. And that was following a loss of 29,000 jobs in September. And you can see that mix of positive and negative, but that definitively slowing jobs growth that we've seen during the past several months. Perhaps a good sign, but somewhat of a modest rebound, but perhaps a good start or a good sign that we didn't continue to see net layoffs for the month of October. But if that jobs report provided a little bit of optimism, some of that was perhaps erased when we looked at the Challenger US layoff announcement. So these are not jobs that have actually been laid off, but they were announcements during the month of October to be laid off. And you can see that spike. In fact, in October, there were over 153,000 jobs or layoffs, rather. If you just look at October as a singular month, that's the highest number of layoffs in October that we've had in 20 years. Now, if you look at the cumulative tally of layoffs during 2025, we are up to nearly 1.2 million, and that's on the heels of the spike in October. But it's also really contributing the government shutdown, and we see that huge spike up to 153,000 during the summer months because of the government shutdown. Now, this recent spike is mostly centered in technology and warehouse and distribution. That's where we're seeing the largest amount of layoffs. If you're looking for kind of their comments around it, it was a combination of cost cutting, automation and improvements in AI, and also a reduction in corporate spending to some extent. So it's hard to pin it on one reason, but there's no doubt that we are seeing an uptick in layoffs across the economy throughout 2025, much of it related to the government shutdown, but also related to this spike up in certain industries of layoffs for automation and other reasons. Now, speaking of government shutdown impacts, a lot of you have probably seen this, but the airlines are going to start canceling flights. The FAA talked and spoke and interacted with the various airlines around the US and basically told them that they need to reduce that flight capacity by 10% across 40 major airports because of the lack of air traffic controllers and other staffing shortages related to the government shutdown. They've been looking at data and they want to be a little bit more on the cautious side to not wait for some accidents to happen because of the labor shortage and the pressure that's putting on the services that they need to provide for those airlines to conduct those flights. So they've asked all the airlines to start reducing their capacity by 10%. That starts this morning at around 4%, and it's going to slowly inch up to 10% by next week or so. All that is related to the government shutdown. We still don't have an exact idea of when that government will reopen. Lots of mixed headlines, but hopefully we get a resolution because this Wednesday we did just reach the mark for the longest government shutdown in the history of the United States, eclipsing the previous record back in 2018, 2019, during early 2019, when we had that partial government shutdown. So hopefully that Washington can come to an agreement soon so that we can start getting jobs data and we have less and less of these impacts for citizens. With that, I want to thank everyone for watching, and I'll see you next time.